I used to trade these 3 blocks, but they had their limitations in my opinion. So I came up with a new refined version, which is a fair value area. Now this fair value area is essentially these 3 blocks, but in one, and there's a lot more to it. So it's not just a simple block that we trade back into to then continue higher. No, on top of that, it tells you, for example, the direction. It tells you if the market is creating a reversal. It tells you and confirms if we are actually sweeping liquidity. And by the end of this video, you will know all these things and more. And you might just become a fan of the fair value area because it can transform your trading for the better. Now, there are 4 steps to understanding the fair value area. And I really want you to understand the evolution of my thought process. So we're going to start off with the limitations of the 3 blocks. Then we're going to dive into the new refined version, so the fair value area. Then we're going to dive into the logic of the fair value area. And at last, we're going to dive into how to use the fair value area. So the first step is the limitations of the 3 blocks. And there are essentially 3 limitations that really held back my trading. Now, before we dive into that, let me explain the 3 blocks again. We are talking about our breaker blocks, order blocks, and mitigation blocks. These 3 blocks were introduced to me, at least by the man ICT. And ICT did an amazing job laying the foundation with those 3 blocks to then I could develop that into, for example, a fair value area. So I'm very grateful for that to ICT. So thank you, ICT, and all credits to ICT regarding that as well. Now, if you do use breaker blocks, order blocks, or mitigation blocks in your own trading, again, this is not a video to say, oh, this is better and you need to start using fair value areas. No. So if those 3 blocks work better for your trading, then stick to it and completely ignore this video. But when I use these blocks, again, I found they had limitations to them, in my opinion. So for example, right here, this is an order block right there. And to understand the fair value area, I'm going to quickly remind you of what these 3 blocks are. So what an order block is essentially in a bearish scenario, so a bearish order block, it's an up candle or consecutive up candles before we start to continue lower. So these up candles right there, that's where we can retrace back into to then potentially continue lower from. So for example, this right here would also now be an order block. So in a bearish trend right here, when these bearish order blocks right there now start to fill, then this bearish order block now turns into what is known as a breaker block. And a breaker block, again, same story. It's what we can potentially continue higher from right there. And then after, what you'll notice is that the last block that we have is what's a mitigation block. So the difference between a mitigation block and an order block, for example, is that a mitigation block doesn't have to have consecutive down candles or consecutive up candles. It's just a full retracement right there before we continue higher. That in itself is also a block that we can retrace back into to then potentially continue higher from, like we see right there. Now, again, you'll notice these blocks, they work quite well. Yes, 100% agreed. But you'll also notice that these 3 blocks are very similar to each other because these 3 blocks can essentially be turned into one simple fair value area. Now, what that looks like when you turn those 3 concepts into one concept into the fair value area, we're going to dive into that in the next step. But the reason why we turn 3 concepts into essentially one concept is because in trading, it's important to understand cognitive overloads. So the more things you need to focus on, etc., the more your performance is also going to decline because your focus is going to be a little bit all over the place, if that makes sense. So when you take those 3 concepts, turn them into one concept, and that allows you to focus on a lot of different other things. For example, you have more focus and energy to now pay attention to your psychology. But when your chart is full of different concepts that can essentially be the same exact concept, then you're wasting a lot of focus. Now, that's the first limitation. Because the second limitation, at least from what I have noticed, is that traders that use these blocks tend to use a lot of different levels. For example, right here with this breaker block, they would then use a Fibonacci tool right there and then say, okay, well, the 0% level right here is valid, but also the 50% right there, but also the 75% right there. So what are you waiting for? What are you actually trading off of right there? And to me, that shows, first of all, a lack of accuracy, but also a little bit of lack of understanding. A lack of understanding of what the actual logic behind it is, if that makes sense. And that's also the third and last limitation, the logic. So because the logic is a little bit flawed, in my opinion, that also makes it very difficult to trade, because then that leads to a lack of accuracy. When do you actually stop trading it, etc.? What can you expect from that breaker block? How far can we, for example, trade back into it before continuing higher, and not just these random Fibonacci levels? And that's exactly where we introduce the fair value area, because this fair value area has a very refined logic behind it, which clearly makes you understand what the market is doing and what you can expect the market to do. Now we'll dive into that in step number 3, but first we're going to dive into step number 2, the new refined version, because now an introduction to the fair value area. As you noticed, what do these 3 blocks right here have in common? Now I won't keep you waiting. They all have 3 swings, and those 3 swings is exactly what makes a fair value area. For example, the first one we had was an order block right there. What happens in an order block? We trade lower, we trade higher right there, and we trade lower again. Where this area right here, that is those consecutive up candles, essentially before we continue lower. Now, if we then move on to the breaker block that we saw right there, what happens right there? We have the same thing as the order block, essentially. It starts off the exact same right there. But then we trade above the high right there, where we have this filled order block, which then turns into also, again, that breaker block. And then at last, we have the mitigation block. Now, for simplicity's sake, I'm going to draw the same exact as the order block, because essentially it is also the exact same. So this, for example, would be the mitigation block right there. They all have 3 swings. And what I mean by that is, for example, the order block 1, 2, 3. Breaker block 1, 2, 3, mitigation block 1, 2, 3. Now, what actually happens at that moment in time? So if we draw the fair value area above it right here, so what happens right here is that when the first swing lower happens right there, the market is essentially offering sellers a fair chance to get involved right there. So imagine a lot of influx of sellers right there makes the market move lower. Then once we start to get this retracement right here, this retracement is where the market is currently offering fair value. What does that mean? It's literally in the concept name itself, fair value. So the market runs on this logic, at least for my trading plan. For you, it might be different. For my trading plan, the market runs on this logic, where the market is either offering fair value or it's seeking liquidity. And that topic is going to return in a later step as well. But what the market is doing right there is, since it's moved too fast towards one side of the market right there with that down movement, it now creates this retracement. That retracement is created because it also needs to offer buyers a fair chance to get involved. It's offering fair value. So when it's offering fair value right there, and once it's done with that offering of fair value, we start to continue lower right there. When we start to continue lower right here, we have one area where we have now offered sellers, offered buyers, and offered sellers right there. But the overlapping area with the sellers and the buyers, so essentially the retracement that we had before we continued lower, that is the fair value area, because both sellers and buyers got a fair chance to get involved. The only area where we have not offered fair value just yet, so where only one side of the market got involved or got a chance to get involved, is below this low right here. So then the logic is that if we are going to offer fair value again, we can only retrace so much to then continue lower again. And that's why, for example, you'll see with the mitigation block example that we had right there, the accuracy is really good. We have an exact sting into the fair value area right there, because the area above this high right there is where we had not offered fair value to both sides of the market just yet. And that's exactly the exact same thing that these 3 have in common. They have those 3 swings right there. They have the exact same logic. For a breaker, for example, it's buyers got a fair chance, sellers got a fair chance, now buyers again. So the only area where we have not offered fair value just yet is above the swing high right there. So then the full retracement that we have before continuing higher right here, that is the fair value area. So we've just turned those 3 different blocks into one simple fair value area. And we know, that's the beauty of it, we know exactly how far it should retrace before continuing lower. For example, this right here is also a fair value area. And this fair value area, the only area that we respect the retracement, then from this fair value area, how far we can retrace is back towards the fair value area low right there, because that again is the only area where we have not offered fair value just yet. To then continue lower from it right there. That leads us to the next step, because as you might see right here, what happens right here? This is also a fair value area, right, Arjo? And it doesn't hold. What happened? And that's the next beauty of this fair value area, and also leads us to the next step as a logic of the fair value area. Because you see the limitation that we had, for example, with a breaker block, an order block, mitigation block, with the Fibonacci right there, we don't really know how far we can retrace, etc. That's all taken away with a fair value area right here. And because the logic is, in my opinion, quite solid, we understand that a fair value area actually doesn't have to hold. So this bullish fair value area doesn't have to push price higher right there in order for us to trade it. So for example, some people's trading plan in the MMT is completely based around on the fair value area actually failing. That's what we call unusual context. So because we have the logic that the market is always offering fair value or it's seeking liquidity, it's doing one of those two things right there. And for example, what we see right here is that this fair value area, the fair value area doesn't hold. We know that this right here is a bearish fair value area that we can potentially continue lower from right there. Then we also know the furthest that we should retrace is back to the fair value area low right here. The reason being, again, as the only area where we have not offered fair value just yet. So if we are going to continue lower right here, then it's going to be from the fair value area low, which you'll see we have a very accurate sting into to then potentially continue lower. But that fails. And more specifically, what fails is this right here. There's a specific pattern to it. And that pattern is that we have now offered fair value. So we try to push lower from it right there. We fail to do so. And once we fail to do so, we then take out the high that had a sting back into the fair value area right there. Because we take out this high right there, we know based on our logic that the market is now not offering fair value anymore. So what is it doing instead? It is seeking liquidity. Where is that liquidity? Liquidity is again above swing highs and below swing lows. What is a fair value area right here? We have, first of all, liquidity at the swing low right there. But next to that, we also have liquidity at the fair value area high right there. So the fair value area high actually becomes the target. So for example, when we start to create new fair value gaps towards it right there, that's what you can trade from to then start to continue higher. Again, it's also a trade I took. So it's not just some hindsight explainings. Now then what you'll notice is, of course, this right here also turns into a fair value area right here. And the reason why I'm now picking the bodies and not the wick, so for example, right here, this is the bullish fair value area. This was the bearish fair value area. A fair value area, to accurately use it, you need to determine if the fair value area high or low is overlapping directly with a fair value gap right there. So for example, this fair value area low right there is directly overlapping with a fair value gap. If that's the case, you use the wick right there. But this wick right here is not directly overlapping towards the right with a fair value gap on the same time frame. When that is the case, you instead use the highest bodies of the fair value area right there. Because then that is going to be the sensitive area. The same way the wick is a sensitive area when a fair value gap is overlapping. So now we understand, okay, well, the only area where we haven't offered fair value just yet is sitting above this high right there. So when we start to create this retracement back into it, and that right there is what we can potentially continue higher from, which we try to do right there. Instead, we fail to continue higher, so we don't offer that fair value anymore. So instead, the fair value area low right here eventually becomes the target. And then again, it becomes this whole inception of fair value areas, because for example, if you now go down the time frame right here, then what you'll notice is that this fair value area right here actually was respected perfectly to then continue lower from it. Where here we were just offering fair value to continue lower. But in the bigger fair value area, the bigger bullish fair value area right here, we are not offering fair value anymore and instead seeking liquidity right there at the bottom. So that is what we eventually then start to continue lower towards right there. But it's important to understand that in both scenarios, so for example, this fair value area that is actually failing, or the earlier one that was actually failing, and the fair value area that was actually holding right there at that moment in time, both scenarios can be traded. So when we offer fair value and we are simply continuing in the same direction like we see right here, and that is what is known as usual context. When we don't offer that fair value anymore and instead we start to continue lower towards, for example, again, this fair value area low right there, and that is what we know as unusual context. And that leads us to the last step, is how to use these fair value areas, because as you can imagine right there, they are quite useful in understanding not only the direction in price action right there. So for example, right here, this gave us an understanding of what the higher time frame direction is at that moment in time. But I think you can also imagine, for example, right here, if we now zoom in again, then on the 1 hour time frame, once we start to come from this bigger fair value area, we start to create these new fair value areas. So for example, this fair value area right there can then also be traded from again to continue higher. And this again is also a trade that I took. So the higher time frame fair value area that we had right there all the way towards the left, that can be used then as the area where you're going to look for your entry confirmation. And the entry confirmation itself can also be again a fair value area that you can then look for an entry off of. But on top of that, these fair value areas can accurately give you an understanding of when we are reversing in the market. So when there's a reversal. So for example, currently we're looking at NASDAQ and this is a 4 hour time frame and we have this bullish fair value area sitting right there. This bullish fair value area right there, whilst we are continuing higher, we are also running into this bearish fair value area sitting right there. So it becomes this battle between two fair value areas. This is also what's known, by the way, as a 50-50 area because price right here is consolidating. Why? Because it's stuck. It's stuck between two PD rays. So now we understand that in order for us to get a reversal in the market, so if we are going to continue higher, we should take out this high right there and we should run that high. Because when we do that, we have now offered fair value, try to continue lower from it. Instead, we take out the high right there. So we are seeking liquidity at the top. And on the other side, we see right here that this low, if we want to continue lower, that's the low that we should run. That low does not get ran because this is also where and how you can use fair value areas to understand what a liquidity sweep actually is. So for example, right here, when we reach below this low right there, what does that low also turn into? Well, this in itself is also, again, a fair value area because we had these three swings. Because we had those three swings, lower, higher, and lower again right there. So when we start to retrace back into this fair value area right there, and we are potentially sweeping this low right there, that means that we are, again, aggressively moving higher right here. Then we can confirm this liquidity sweep by understanding if the fair value area right there is failing. So we offer fair value right here through this singular candle right here. And that singular candle right there is the rejection high off of this fair value area, which then starts failing to then continue higher again. And then the fair value area high, of course, becomes the target. But not only the fair value area high, because this high becomes the target, that high becomes the target. These next highs also become the target. And the reason why those become the target and how we've been able to call that is because of this next video right here. All right, perfect.